Welcome to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. And Stewart is co-founder of Asset Preservation Tax and Retirement Services. Stewart, how are you today?
Oh, I'm doing awesome. How are you doing?
I am doing fantastic, doing really well. I'm always looking forward to our shows together because obviously so much incredible information is being delivered. We typically have Judd with us, but he's not with us today. Is he at the office?
You know, he's swamped right now. He does a lot of our really neat cash flow work. So, you know, I get to be the one on TV today. So, but he'll join us again soon.
Well, great. Can't wait to have you both together, but I'm really thrilled to have time with you today, Stewart, also. So wanted to jump right in and just ask you, what has life been like in the office lately? Because I know you've been so busy and you're growing at such a rapid rate. Let's talk about that.
Sure. Well, you know, at the end of the year, it was absolutely, I mean, you know, I'm making calls on December 31st. I'm asking for favors for these Roth conversions. We deal with some really great, you know, companies, and they were very, very, you know, accommodating. And so I apologize for all the stuff I was asking for my clients, but guess what? It's not going to stop. So, you know, we've been busy, but we're busy because we're advocates of our clients.
Sure.
And it is really important to make sure that, you know, you've got somebody that's working on your behalf.
And it's so important, especially like you mentioned, you said the magic word, advocate, because especially as you're approaching the retirement years, it's not a time that you want to do anything alone. You want to have someone that's next to you to guide you the entire way through, and you and Judd are so good at doing that.
Well, thanks. No, you know what, it's an easy job for us because we surround ourselves with great people. You know, our clients are amazing, and you know, I think it's really important. I've said this in previous shows. It's really important to make sure that the chemistry makes sense. If you've got an advisor that you don't really like or you don't really trust or whatever, you know, it really is worth kind of, whether it's with us or somebody else, it really is a problem if you guys don't really get along, right? And to me, that's just kind of a minimum. You need to get along. Well, you also need to make sure that they're acting in your best interest on all fronts.
Absolutely. Stewart, let me ask you, are there different management styles when people are working with advisors?
Well, sure, absolutely. So historically what we've seen is a very passive approach, a standard, you know, model. So a lot of classical, you know, stockbrokers and financial advisors use a very passive approach. And when we talk about passive, we have this graphic on the screen now. It really does illustrate what I'm talking about. So a lot of people will have a 60-40 split. So 60% equities, 40% bonds, or 60% bonds, 40% equities, or 60-20-20, 70-30, whatever. And the reason they're doing that is because it's really easy. You know, it's something that's super easy. They basically once a quarter they reallocate back to you know, to these numbers. It's a super hands-free autopilot kind of situation where, you know, they you know, these rebalancing efforts that occur quarterly or, you know, twice a year, it kind of creates the perception that the advisor is paying attention because he's seeing transactions. But the reality is it's all computer modeling that's doing most of that there. So that's the passive approach. At Asset Preservation, what we tend to use is tactical models. And let me show you an example of one tactical model here. So one of our money managers that we use has an algorithm that has basically identified 6 very distinct stages in the economic cycle. And you have to just, let's break this down into super simplistic terms. If we are in a recession, you have to believe that there's different investments that do better in that environment than if we're in an expansion. And if you take a look at the graphic, you'll see some of those changes that are made to the algorithm. Now, the reality is, the difficult part, and the whole reason we need these money managers, is to identify where we are in that economic cycle, right? And so there's a lot of math that goes into determining whether we're in a recession, is the market going to crash, etc. And so the goal at Asset Preservation, it isn't to beat the market on the way up. It's to make sure we don't lose as much on the way down. So a lot of these people that have been chasing yield on the way up, that's great in an up market. But the reality is that if, you know, we go to clients and we say, hey, what kind of risk are you willing to take? And they say, well, what do you mean? I say, okay, well, you've got $500,000. What if you lose $25,000? Is that okay if the market crashes? Yeah, I think I can handle that. How about $50,000? Yeah, I think it's okay. How about, 75? Well, the point is that everybody has a pain threshold eventually, right? They're going to say, okay, that's too much. And I think what we're seeing is that a lot of people are taking way more risk than they think they're taking. They have no idea what kind of risk they're actually taking.
Sure.
So, yes, you could be doing well, but are you doing well relative to the risk that you're taking? So here's what I'm talking about. What we seek in our portfolios is something called alpha. Now, what alpha is excess return. So here's an example. If you're taking 100% of the risk of the market, what you would expect is 100% of the return of the market, right? But there are things that drag that down. Number one, poor management, poor money management. Number two, fees. And I'm not just talking about management fees, I'm talking about those hidden fees inside the portfolio, inside the actual underlying funds. So those kind of parasitic drags on your portfolio really have a big impact on that overall, outcome. I mean, most money managers can't keep up with the S&P 500 over time, right?
Absolutely.
So when you start adding their fees on top of that, what are you really paying for?
Yeah, absolutely.
You just want to make sure that you're dealing with someone that really does handle things well. And the one thing at Asset Preservation is that we don't have the guy down the hall picking our portfolios for us. If you're dealing with an advisor who says, hey, I really like this fund or I really like this stock, I would question what their capabilities are to really determine whether it's a good or a bad stock, right? They may be a nice guy. And, I jokingly tell my clients, listen, I went to one of the best public universities in the world. And you don't want me picking your stocks for you, trust me. Why? Because we have some of the best people in the world watching. We have, some of these, we literally have the biggest money manager in the world overseeing one of our portfolios. And it's this really exclusive deal that it's really difficult to get. But we have those relationships to have really world-class asset management with clients that have never been exposed to it. Most people are used to these very, I'll just call it a retail grade relationship. It's kind of like, if you go to grocery shopping, if you go grocery shopping at the grocery store, say you pay $100 for it. Well, if you go grocery shopping at the liquor store, you're gonna pay $250 because they're different, quantities of scale here. These economies of scale are differently. And I think a lot of people are doing their grocery shopping when it comes to financial planning at the liquor store, and they're just paying these uber retail things. These fees are just outrageous.
And so many times, Stewart, like you mentioned, people have no idea how many fees they're actually paying until they come in to sit with you. So this is the perfect time for us to open the phone lines. Would you agree?
Absolutely.
Okay. To the viewers at home, the phone lines are now open, and that number to call is 833-652-7829. What Stewart is offering you today is a complimentary portfolio review. Let him take a look at what you currently have in place. Is it the right plan for you? Or do you need to have a plan designed from scratch? Stewart and Judd can help you with that as well. Again, all you have to do is pick up the phone and call. The number is 833-652-7829. It's a complimentary consultation that's waiting for you with just one phone call. Again, we have to take a very short commercial break, but when we come back, I'm going to have some more questions for Stewart about how to plan your perfect stress-free retirement. Please stay tuned.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have. By running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no-obligation, full-blown financial review today.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. And Stewart is co-founder of Asset Preservation Tax and Retirement Services. Stewart, a great show that we're talking about today, actually with just management styles, if you will. So we've talked about, of course, tactical versus passive. So I have to ask you, why aren't more advisors using the tactical approach?
Well, the reality is that the tactical approach takes a lot of work. And what we're seeing is that a lot of advisors are doing the picking themselves. So it's really hard to create a true tactical approach if you don't have the capabilities or the metrics in place to be able to measure those things, right? It's a lot of work. Now, what we do is we actually use, like I mentioned previously, some of the best and biggest institutional money managers in the world to oversee our clients' portfolios. And remember, those portfolios that we manage are all housed at either TD Ameritrade, which is right in the middle of a merger with Charles Schwab, which is awesome, or Fidelity Institutional. So whether you're at Fidelity or TD Ameritrade, we handle both sides of those accounts. And the reality is that most advisors will have the guys in-house. So they've got a guy down the hallway that does all their portfolios, or the guy that you're actually meeting with as a client is picking stocks and bonds and mutual funds, etc. We just don't want that. And the reason most people do that, most advisors do that, it's a lot less expensive to them. I don't mean to the client, but to them. So if somebody is, they've got an employee on staff for $100 grand a year, which is a lot of money, but when they're managing hundreds of millions of dollars, it really, as a percentage, is really low, right? Well, the way we do it is more expensive to us, not necessarily more expensive to the client, but what we do is we sleep a lot better knowing that we've got people like BlackRock, like some of our other institutional money managers that are overseeing these portfolios. Because if let's say I'm on vacation, and that's only a dream right now because I haven't been on vacation for over a year because they keep getting canceled. But let's say I am on vacation and I'm enjoying myself with a couple Mai Tais. Well, the reality is you don't want me picking your stocks, or if the markets are shaking up, you don't want me picking your positions. We have people watching 24 hours a day, watching these portfolios all the time. And that's what you want. It's a team of money managers there that are overseeing the perspective of your accounts.
Absolutely. Thank you, Stewart. Let me ask you, why wouldn't someone just invest in an indexed fund? Well,
the truth is that an indexed fund is actually appropriate for some people, right? So if you're just starting out, let's say you're under 35 years old, under 40 years old, you've got a few $1,000s saved. Honestly, the S&P 500 is really a great index to follow. But what we're seeing is that a lot of clients, in kind of our ideal client, you always ask me, well, what type of person is your client? Well, our client is a person that's approaching retirement or has got 5 or 6 years left until retirement occurs, 58 and up, and they are basically trying to make some plans going into retirement. Now, those people are, have generally accumulated some savings, right? So whether you have, $200,000 or $1 million or $10 million, those people generally are in a different position because they can't just keep swinging for the fences. What they want to do is make sure that if Armageddon occurs, that that they're not going to take the full brunt of the market declines like we saw in 2000 or 2008. 2008, or even what we just saw during the COVID drop, right? So a lot of people have realized once they've had money invested for a longer period of time, they've seen these substantial drops and they're just not willing to take it. And that's really where we come in, is we're really good at managing the downside of these portfolios, because it's not just about making more on the way up, it's about not losing on the way down. And I think that that's what we do specifically very well.
Stewart, can we talk a little bit about the difference between stocks and bonds, if you will?
Sure. So classically, when we talk about classical, asset allocation, what we'll see is people that have a combination of stocks and bonds. Bonds are typically what people consider the safe part of the investment, and historically that's been true because we've been on a 35-year bond bull market. And what that means is that interest rates have dropped since the 80s. Interest rates have dropped dramatically, from the 10-year treasury going to 15% to all of these sub 1%, environments that we're in right now. So the concern with bonds being safe is that, let's say you buy a bond that, pays 6% right now, and because it says 6% on your bond, well, what if next year interest rates raise and now they're paying 7% or 8%? Well, your bonds become less valuable. But we haven't had to worry about that for 35 years because interest rates have systemically and systematically fallen. So it actually increases the value of the underlying holdings. Right now, understand the pressure a lot of money managers are under on fixed income, which are bonds. Their fees sometimes exceed the yield of the bond itself. But then now what we're talking about is some of what we call disintermediation risk. If interest rates rise, think about it like this. If the 10-year treasury is paying 1% today, next year it pays 2%, who's going to buy a 1% bond, your old 1% bond, when they could buy a new 2% bond? Well, someone will buy it, but they're not going to pay you $100 for it. They may pay you $75 for it, depending on the time, to maturity and so forth. There's a lot of complex calculations there. But what we see a lot of times with people in bonds is that they're misled into believing they're making certain rates of return. There's some kind of techniques advisors use. We're not seeing a ton of individual bonds anymore, but when we do, what we'll see is people that'll have a bond that'll say 6.2%. And my clients are like, look, I'm making 6.2%. Why would I change that? That's all. I can't get that now. Well, then you look back at what their cost basis is. What do they pay for it? Well, it was a $100 bond at issue when it was originally issued, but it shows their cost basis at $132. So they paid $32 more for that bond than it was at par, the par value. So they're not making 6.5% on $132 they paid for it. They're making 6% on the $100 that it originally issued at. And so it's really kind of misleading there to believe they're making that rate of return because they see the yields on the bonds. Of course. It all depends what you paid for it.
Of course. Is there a certain percentage that you would recommend that's allocated to bonds in someone's portfolio, Stewart?
It's a great question. So we have, two of our main money managers look at it very drastically. So, we'll take a look at our algorithm money manager. Basically, when we showed you those economic cycles before, they will be willing to completely shift. At times they have 80% equity in a moderate portfolio, which if you look at in a static way, you'll think, oh, that's aggressive. Well, it's not aggressive relative to the environment we're in. It's aggressive if that's all you're doing is holding that position. So, one of our managers would say, you know what, it all depends. The other one that we use, one of our, the bigger money manager that we use, basically believes that you keep along those asset allocation splits and, whether you're a 60% equity person or an 80% or 100% equity, it all depends on your willingness to lose. I think advisors are really scared to talk about that with their clients, and you need to just come to the reality of what kind of loss are you comfortable taking, and does your portfolio match up with that willingness to lose? It may or may not. You should take a look.
Absolutely. Stewart, thank you so much. This is the perfect time for us to reopen the phone lines. Would you agree?
Absolutely.
Okay. To the viewers at home, the phone lines are once again now open. That number to call is 833-652-7829. What Stewart is offering you today is a complimentary consultation, a portfolio review, if you will. Let him take a look at what you currently have in place. Does it need to be tweaked somewhere? Is it the right plan for you? Stewart and Judd can make sure that you're in the right plan so that you can retire comfortably and with peace of mind. Again, it's a complimentary consultation that is being offered today. All you have to do is pick up the phone and call. The number is 833 833-652-7829. We have to take one very short commercial break. When we come back, I'm going to have some more questions for Stewart about how to plan your perfect retirement. Please stay tuned.
What happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old. They've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement, knowing that they're not going to run out, that they're going to be fine. You know, I think it brings a smile to their face.
We get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. Keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, you know what, 5 years, 3 years, tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning. We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes? It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. And Stewart is co-founder of Asset Preservation Tax and Retirement Services. Stewart, a great show we're having today. And obviously, when we go to the commercial breaks, I love to watch the phone lines light up. I know you can't see them from the direction that you're looking, but I get to watch that excitement. And so if someone was fortunate enough to gain one of the complimentary consultations with you and Judd, what can they expect to feel when they walk into your office?
Well, the first thing, depending on the office they show up at, whether you come to the Scottsdale office or the West Valley office, the one universal thing is that you have amazingly friendly people, right? It's very unassuming, people think about wealth management in these very stuffy places where, you just don't see that at our office. We're very relaxed. We also have the understanding that we're not a right fit for everybody. And, when people, call initially, they end up kind of, getting concerned that, hey, oh my gosh, this crazy sales process is going to occur there. And this is not how we operate. We are very relaxed. What we're there to do is, is to take a look at what the clients are comfortable bringing in. So it is important that clients bring in some statements so we can do an analysis of their portfolio if that's what they're, coming in for. But also some people will bring in tax returns because they do like the conversation we have about taxes. The fact that we look at every aspect of financial planning, whether it's, a financial planning and wealth management, whether it's tax planning or estate planning, we make sure that the whole picture is looked at. There is no stone we leave unturned at our company. And I can tell you, the one thing I hear all the time from clients is they say, wow, you're exactly the same way you are on TV. So if you don't like me on TV, don't come in person because I'm telling you I'm the same person, right? And, Judd's the same way, right?
Yeah.
He's just kind of an analytical guy. The engineers love that guy because he's a math guy. And where I'm, I plan in a different way. We're both, different, but the neat thing about our company is that we work as a team. So whether you visit with Judd or I, we always get together. We talk about the plans in our board meetings here. We always make sure that we get all perspectives on what's going on. Our tax people sit in on those meetings as well. So if they have any additional insight, they can add it at that time. So it's really important.
Okay. And Stewart, that's obviously the first consultation, but then how long does it take you to design that plan for someone? Is that more of the second and third meeting, or how does that look?
Yeah, so the first meeting is really just about getting to know each other, getting a broad view of what's going on there. We can take a look at some of the statements and so forth. What we do going into the second meeting is generally the portfolio analysis to look at what kind of risk they're taking and so forth. And remember, it is absolutely complementary. Some people are comfortable with the way I describe it, but I say, listen, it's like a first date. We're just trying to see if we jive together, right? Mm-hmm. And listen, if worst case scenario, we give you some information you can walk away with, and that's it. That's okay, but what's important is getting a second opinion. If you've been with the same advisor for years, or even if it's a recent relationship, you want to make sure that you have somebody taking a look to get a second opinion on your portfolio, because oftentimes, going into the very turbulent times we're seeing now, people just don't understand the kind of risk they're taking.
Sure. And
going into the second and third meetings, the second meeting is portfolio analysis. The third meeting is when we start going into cash flow and income stream planning and so forth. But it's all about the planning.
Okay, absolutely. And you mentioned something that's very important. Mm-hmm. Obviously, having a second opinion. So if someone is in the viewing audience today, they currently have been working with an advisor for years, it's very crucial and critical for them to have a second opinion from a fresh set of eyes, yes?
No doubt about it. I think, listen, we have clients, we are, our main office is in Sun City. We have tons of clients in Portobello and Sun City Grand, Coyote Lakes, all of these great places, as well as in Scottsdale. And we have people that come in here. We're the snowbird capital of the world here, right? Mm. And people come in from all over America, and they've had these relationships for 10, 20, 30 years, and they just don't want to break these relationships. Well, we're not asking you to do that at this point. We're just trying to ask you to say, hey, let's take a look. Does it still fit into your current model? Life changes, and we just want to make sure that you're taking the appropriate amount of risk relative to what you're comfortable with.
We have less than a minute left, Stewart. Mm-hmm. Can you give one golden nugget for advice for 2021 to the viewing audience?
Well, I think the one thing I would say going into 2021 is have a plan. Consider taxes. Taxes are an important part of what matters. And also try to give back. If you go to www.apsitaxes.com, that's our website, we have a link up there that will link to St. Mary's Food Bank, and we are going to match dollar for dollar every dollar you contribute up to $20,000.
I love that. Thank you, Stewart. Thank you so much for giving back. To the viewers at home, thank you for spending time with us today. The number to call once again is 833-652-7829. You deserve the retirement of your dreams. Stewart and Judd can make sure that you have exactly that. Be safe, be happy, be blessed, and we'll see you next week.